February 22nd. I'm your host, Samuel McCullough, and I'm joined here with DeFi Advisor. How are you? Good, sir.
I'm good, sir. How are you? How is everyone?
Things are just filled with love and drama at the same time today. But we'll get into that later. But today, we actually have on a great guest who's here to come and talk about the lending markets on Arbitrum and how they've just exploded over the past few months because of Arbitrum STIP and just renewed demand for leverage. And that is Teddy Woodward from Notional.
Hey guys, thanks for having me on.
Yeah, great to see you here.
Yeah.
So I think we should just hop into this Dune dashboard first, because I think it tells a great story of what's happening on Arbitrum and how fast you guys have just actually been growing. So this is a month-long chart that shows the notional V3 TVL on Arbitrum, and it's just up only. You guys have gone from just around $1.5 million of TVL, and it's 10x in the past month, up to close to $15 million of TVL.
Wow.
Yeah, it's been awesome. It's been really exciting. It's been great for us. We worked really hard on Notional V3, and it's just awesome to sort of see it take off and provide value to the people who are using it. Yeah.
So maybe you can talk a little bit, and I think we've discussed this before, just about what Notional is doing with the STIP and how you guys are implementing it.
Yeah, so maybe I can give a just like a quick little TLDR on what Notional is first. So Notional is a lending protocol. So you can lend your crypto assets and borrow against them just like you would on any other lending protocol. But kind of what makes Notional different is I think we are, we call ourselves the most advanced lending protocol in DeFi. And what that means is we offer advanced yield strategies that deliver high APYs using leverage. So they're like one-click strategies that allow you to lever up and earn really high APYs using that leverage. And so that is I think the success of the leveraged yield strategies is primarily the reason why we've seen all this growth. And especially the growth in the total debt. So what's been happening on Notional is, with the ARB STIP grant, we've been incentivizing depositors, and then we're getting a lot of demand to borrow via sort of internal looping strategies. So you can get leverage on your deposits on Notional. So if you look on the Earn Yield tab and you navigate to Leverage Liquidity, that has been kind of by far the sort of most popular strategy right now. And basically it allows you to get leveraged exposure to providing liquidity on Notional and earning those ARB incentives. So we're getting a ton of volume from that, which is increasing rates, and we've also got leverage vault strategies as well, which are also providing high APYs. But it's really these high APYs that are attracting everyone.
Yeah, the Arbitrum STIP has provided a massive amount of rewards to come into the network over these few months leading up to the end of March, and it really shows in the yields at the moment. My question for you would be, how do you plan on transitioning from the STIP to the LTIP, where there still will be some rewards, but the idea here is that hopefully this leverage and TVL that you have coming in will be sticky afterwards.
Yes. Yeah. So I think it's so what I would say is kind of our plan once the STIP for Notional ends at the end of March, and there is this kind of long-term incentive program, but the details of that program are such that anyone who got a STIP or a STIP back fund grant is ineligible to apply for like the first wave of this LTIP program. So there will be at least some period of time where Notional does not have additional ARB incentives, right? Now, what we plan to do here is lean on our other leverage strategies that source yield from external DeFi protocols. So something that's been happening right now is like the majority of the debt and the interest on Notional has been based on like this leveraged liquidity strategy, which is kind of an internal looping strategy. And that is like, the reason for that is because that's just like, it allows you to directly access the ARB incentives, and it's like super low risk. There's like very, you just get ARB incentives, and there's very little risk of loss. It's a simple strategy, and so it's seen sort of like the overwhelming interest. But we also have these leverage vault strategies that essentially allow you to earn yield from external protocols like Curve, Balancer, Aura, and Convex. And we think that once the STIP runs out, this sort of internal leveraged liquidity strategy isn't going to have as much capacity, but we hope to replace the borrowing demand with these leverage vault strategies that source yield from external yield sources.
Interesting. Yeah, I think the STIP is really supposed to be like a kickstart to drive demand, drive people into protocols, and then hopefully the yields are strong enough that they want to stay once the STIP program is over. But it does give protocols like yourself who are just entering ARB the ability to come in and really attract users, and that's really been the case that you've seen with Notional here.
Yeah. I think it's like it's been great for sort of getting us exposure in the Arbitrum ecosystem. When we first launched, we didn't, we had obviously zero footprint and didn't really know the ecosystem very well, and people in the Arbitrum community and users didn't really know Notional, and I think that has changed a lot because of the STIP. So we're super thankful about that. But yeah, I would also say that this was this was kind of experimental for us, as it was for, I'm sure, like a lot of protocols. And, if we kind of look back on it, I think that we could, so a good thing about the STIP is that it's given people a reason to engage in Notional and figure out Notional's products. But I think a bad thing about the way we've implemented the STIP grant so far is that basically all the attention has gone to the leveraged liquidity strategy, and as opposed to the leverage vaults, because the leverage vaults are not getting any of those STIP incentives. And I think if we had it to do over, we would probably put some of the incentives on some of these other products as well, just to get people to engage with more of the products that Notional offers. Because I think that has been an issue, and it's something we would change, in future incentive programs. I think it's something we'd be looking to change, where we don't put all the incentives on this leveraged liquidity strategy, and we instead put some on the leverage vaults too.
Can you talk about the difference between the leveraged liquidity and leverage vaults? Like how should I understand the difference between the two?
Yeah, so leveraged liquidity is like an internal looping strategy on Notional. So the cash never leaves Notional, right? So it's like you borrow on Notional to lend on Notional and earn incentives, right? So it's an internal strategy, right? Now the leveraged vaults source yield from external protocols. So they will borrow on Notional, take the cash, and put it on an external protocol and earn yield that way, right? And I can go through a particular strategy if that's helpful.
Well, I guess I guess this leads into the question. I mean, it kind of sets it up when designing a new lending protocol. say like Notional, to come in and I don't know about like take market share away or at least like draw new market share in from the incumbents like Aave and others that are on Arbitrum like Radiant. How do you set yourselves apart?
Yeah, I mean, so I think that that's a good question. And our general strategy has been so on Notional, you can lend and borrow like a regular money market, right? So you can do all the same things. You can put wrap stake ETH as collateral, borrow USDC, and you're on your way, just like you would on Aave or Radiant. But that isn't really our focus right now because we think that it's like it's hard to compete on those terms with an incumbent like Aave, right? Because like you're offering the same product but worse because like you don't have the liquidity of Aave, you don't have the track record, right? So like our strategy has really been to focus on a differentiated product, which is these leveraged yield strategies, which is something that very few people offer. And I think that Notional is kind of uniquely positioned to like offer a really competitive product there and sort of build up our position by going after this kind of more niche use case.
Yeah. And so I think the reason that we wanted to have you on was twofold. So the other day, you guys talked about how you had broken $50 million of open debt, which is a big milestone. You're almost on your way to 9 figures.
Yes. It was really cool. Yeah, I'm very, very happy about that. Yeah.
Yeah. I mean, it's really like it's the first step in getting towards being $1 billion protocol, where you have this type of TVL, and for the amount of TVL that's coming into Arbitrum, I mean, that's entirely possible over this year.
Yep.
Can I ask how much was it before the STIP started?
Yeah, it's certainly much lower. I think before the STIP started, it was maybe 3 to 5 million in open debt. I'd have to look back at the Dune dashboard, but I think it was probably in that range.
Yeah. So back in January, it was trending downwards or trending upwards at 15 million on the 23rd of January. The charts don't really go back before then. And now it's come up and it's broken 50 million during that time period.
Yeah. It's been wild.
So how do you see the growth of the variable rates vaults versus the fixed rate vaults that you have? I mean, long term, would you like to have more fixed rate versus variable?
Yeah, I mean, I think that's a really good question. So, this is like an interesting. This is something we talk about internally. So I think like what we had seen prior to the STIP, right, was that people started with the variable rate because I think maybe it felt most familiar. But then what we saw is that over time, because we didn't have much liquidity on Notional, so what you had happen was the variable rates were very volatile, right? So it was like common for the variable rates to spike, which really hurts your leveraged, your all-in yield, right? Because like your all-in yield is a function of what you're earning and the interest that you're paying on your borrowing. So if your borrow rate spikes, your total APY gets like really seriously impacted. So what we saw was that like people would start with the variable APY, then the borrow rate would spike, and then they would switch from the variable borrow rate to the fixed rate. And so we saw like, maybe I think variable rate borrowing was like 90% of the debt at the start. And then it steadily went down to like, I think 70% was kind of the low point in terms of the share between variable and fixed. So what we saw is that like people figured out the value prop of fixed rates like over time as the negative like effects of variable rates like showed themselves.
So with the fixed rate borrowing, am I able to come in and say deposit Steth and then borrow out ETH at 3.3%? Is that possible?
Yep.
That's pretty good. Yeah. And then do you get the lending side of it and the borrower side?
Yeah. So if you put in, wrap staked ETH, you get to earn, you can choose how you want to earn yield on the wrap staked ETH. You can earn the variable rate, you can earn the fixed rate, you can earn the incentive, like provide liquidity rate. And then you can also use that as collateral to borrow the ETH. So you can like loop that if you want.
Very cool. Yeah. And so like it allows you to essentially take the steth, which is earning 3%, and then lend it out at 1.9% and then borrow at ETH at about 3.3% right now. So there's almost a 2% gap in there that you could lock in of yield.
Yeah, and we're actually, so we actually this product is coming soon, TM. Not immediately, but we just actually went through audit for a product that automates that entire process for you. So it's like, and it puts it in a separate collateral context, so you can use high leverage. It's kind of like Notional's version of E-mode on Aave, but we're gonna have like a custom UI that'll do the whole thing in like one click and just like give you a tailored experience to do exactly what you just mentioned, Sam.
Yeah. And so how does the like business development onboarding of institutional funds, like how much does it matter when dealing with lending protocols? I mean, is that the majority of outreach here is like calling up people saying like, hey, come into Notional, we can provide these services? Because you can build the thing, but it doesn't mean that people are going to actually come and use the product.
That's very true. I would say that from like a BD and marketing side, we've really been focused on I don't see how you would like crypto native non-institutions to start with, because those are the people that are most willing to try something relatively new, right? So like when you think about institutions, generally they're going to be more risk averse. They want to use something that's they want to use like the default or the standard product, right? They're less like willing to experiment. Now I think that like ultimately what Notional offers and what we're building is like suitable for people who are sort of more institutional or professional. But like right now, like for Notional V3, it's not at the stage of development where it really like makes sense for those people. So I think that those like users will come, but not quite yet.
Yeah. And again, it's like, go ahead, DeFi Advisor.
No, I was just going to add on the same point, like, because these investors are for sure not just going to come. You know what I mean? It's all about like how will these kinds of different investors will be attracted by I think the different protocols building in our space. Of course, each according to its its perceived relevant audience.
And I would actually say that I think that the discussion of institutions is it's interesting in the context of DeFi, because I think people, when they hear that word, they generally think of like TradFi institutions.
Yeah.
But I actually just like I've always been we started Notional in 2020, and for years I would say I've had high conviction that the growth in DeFi really comes from DeFi natives and not traditional people. Because generally, like traditional like institutions, they want to do things their way and not the DeFi way, right? And it's like ultimately you're gonna have to like they're just gonna have to kind of get with the program. Like that's my feeling, where it's like if you try and make something that's geared towards people who are fundamentally not crypto native, like what you're going to do is you're going to make something that nobody actually wants to use, and you're going to waste a lot of time trying to get these traditional people to use it, and they just never will, right? And like, so I actually think when I think of like institutions using Notional, what I think of are DeFi-native institutions, and in practice that looks like, you know, people like Yearn, people like Sommelier, Solve, right? These are actually what I would consider DeFi-native institutions, because they offer a managed yield product to their users, and then they're the advanced, sort of more professional ones that actually go earn the yield through these sophisticated strategies, right? Like that's what a hedge fund does, except this is done in the DeFi way. And so like these are actually the kinds of more professional users that are going to use DeFi protocols.
It's a good point.
Yeah,
it's a really good point, because I think we've talked with the Sommelier guys, or at least I have talked with them, and you know, the idea of building complex vaults on top of existing DeFi infrastructure is pretty open in the design space. I mean, you can really come up with any strategy that you want to. And so relying on third parties to kind of build around you is a value add for you.
Yeah. I think it's something. So my background, I was in TradFi before I got into started building Notional. I was I was a derivatives trader, so I traded interest rate swaps, and so I think there's like a general misconception that a lot of crypto, you know, people have about like hedge funds and what, you know, what these people do, and think they're so special and smart and sophisticated. And then it's like they, you know, it's really like the sommelier thing is really no different. Like that is what a hedge fund is, right? And it's not anything more special than that.
An inside look, you say, into hedge funds?
Yeah. Well, I just think that, like, you know, if you're not familiar with it, you can tend to like get caught up in some kind of mystique that is not actually warranted.
Yeah. For me, for example, I think that I really like, I'm so far away from it, like from where I came from, that I just probably picture it like it's a movie. You know what I mean? It's probably so far off than how it really is.
Yeah. Well, and it's also like, not to get into like conspiracy theory, but like it's also like they perpetuate this image, right? Because it allows them to just take these ridiculous fees because like
exactly.
everyone thinks they're so smart.
Yeah. By the way, it's not the only industry that does that. You know, every industry that can, like, I don't know.
Gatekeep.
Yeah, exactly.
So let's talk about Arbitrum. You guys have essentially pivoted, and this has been your biggest growth sector over the past few months.
Mm-hmm.
How do you guys look forward into 2024 with other networks like Optimism, Polygon, all trying to compete in the L2 space? For
Fraxtal, Berachain, who knows?
Yeah.
That's a good question. So I would just say, like, so the first thing I'd say is like, you know, the very next thing that we're doing on Notional is actually deploying V3 on Mainnet. So it's not another L2, it's going to be Mainnet. And we have a ton of opportunities that we're like really looking forward to there. There's like a lot of stuff going on Mainnet. So we're going to have vaults that are focused on CRV USD liquidity pools, Go liquidity pools. We're going to have the leverage restaking points vaults. Yeah, there's a lot of stuff coming from Notional on Mainnet, in addition to Arbitrum. But with respect to like other L2s and kind of, you know, just the L2 landscape, I would say that like, you know, obviously we're sort of open and not sure what the strategy is, but my bias is definitely to, I would like stick to Arbitrum. And that's really because, like, you know, I think the culture in Arbitrum is good, and it's very DeFi focused. And I think like Arbitrum, the DAO has made pretty like real commitments to continue to foster DeFi activity through like long-term incentive programs. So I think like the conditions are there for like, I think Arbitrum is going to be a DeFi place in the long run. So it makes sense, like when you're thinking in the long term yourself about like continuing to invest on Arbitrum rather than other L2s. And I think for Notional, like if we were to, deploy on another L2, just in general, like we feel like our strategy is not going to be to like copy paste and go everywhere and be everywhere. That's just not what we're going to do. We are going to sort of invest in particular ecosystems, and partially that's like just a result of like, we have limited manpower, and but also it's a result of the fact that Notional is a very integration intensive business. So unlike something like Aave or Uniswap, where it's like easier for them to copy paste because they don't have to integrate with other protocols. Like the whole kind of premise behind Notional and these leveraged yield strategies, these leveraged vaults, is that we integrate with external protocols. So like every deployment in an environment like requires us to integrate with other protocols in order to like do anything worthwhile and be productive. Yeah.
Why did you actually? First of all, congratulations for going to Mainnet. I didn't know that you guys were doing it. It's like moving to the big league in a way.
Yeah. Well, moving back to the we started on Mainnet, so Notional V2 launched on Mainnet
okay.
in 2021. So it's like going back. But yeah.
That's cool. That's cool because it actually leads me to my question. Like, what makes you think that Notional is currently like ready for the move? You know what I mean? Like, what made you actually take the decision? Because I think it's it's quite a big step to actually like liquidity is magnitudes higher on Mainnet, and like all of a sudden, like you said, you're starting to compete with a whole other level of both competitors, but also like the users are pretty different when you go to Mainnet.
Yeah, I mean, so we, Notional V2 was on mainnet. We had like a ton of TVL like for a time on mainnet, and so I think we do have like a user base on mainnet that's very familiar with us. So that's that helps. But in terms of like why we felt now was the right time, I think we've been on, so Notional V3 has been on Arbitrum for roughly, I would say 3 to 4 months at this point. And it's like we have improved the product a lot, and like we've fixed like a lot of problems that we had on the UI, just kind of bugs for they come with doing something new. And so I think that the product is pretty good and like pretty polished at this point. And then, we just see like, honestly, like a lot of opportunities on mainnet that aren't yet on Arbitrum. I think that the opportunities for these leverage yield strategies that we have on mainnet are very significant. I think like the most obvious one that everybody's super excited about right now, and we're definitely very excited about too, is the leverage restaking. So that's only on mainnet, right? So if you want to like participate in that, you've got to be on mainnet. And we are really excited to offer leverage restaking vaults that we think are going to be, really, really attractive. I think that's going to be like some of our first vaults that we offer right out the gate. And then we're, also going to be offering, like I said, strategies that like leverage the yields on CRV USD liquidity pools, Go liquidity pools, PYUSD. Like there's lots of great opportunities on mainnet. So I think we're ready to take advantage of that and kind of bring Notional's leveraged yield strategies to sort of the mainnet audience.
Very cool. Well, everybody should go check out Notional. I think that it has some Frax on there, and I've been reporting on it for the past couple of weeks. That pool's gone from like pretty much 0 up to 5 million in just a few days. So it's attracted quite a lot of lending into it, as well as the leverage vaults as well too. So worth checking out. I've been keeping up on it, and I think you guys should too. I do want to talk about 2 other stories before we wrap up today. And Teddy, you can keep mum on the next one if you want to. This is like, we're going to talk about drama alert, and that is that Gauntlet decided to leave Aave. So Gauntlet is a risk analysis company that was providing risk management services to Aave for the past 4 years. They have been instrumental to Aave's growth. And yesterday, John Morrow, the co-founder of Gauntlet, said that they are going to not continue any more work with Aave and will be terminating their payment stream as soon as possible. I think this one was a long time coming. If we look back at the whole fiasco with Mitch and the CRV drama that took place on Aave v2, Gauntlet was one of the risk management teams that proposed to completely offboard Mitch. They wanted to essentially completely pause his deposits, not allow for any more borrowing, and take aggressive steps to offboard CRV at the time. Unfortunately, that didn't really match the view of many other people that were on Aave at the time in the DAO, and so their request was rebuffed. From that time period, I think there was a breakdown of communication between the Gauntlet group and then also the Aave Chan initiative. And so their work has ended today. And so I believe that they are transitioning to go work with Porpho, which is an Aave competitor. And so I don't think that this means the end of their business, but it does mean the end of their relationship with Aave. As usual, Mark had some choice comments to talk about us, or to talk about Gauntlet, saying that, you know, they factually benefited of about like $10 million. Gauntlet also raised $23 million at a $1 billion valuation. And so we shouldn't really cry for them at all. And he also said, Mark has not been nice to us as a poor excuse to justify Gauntlet looking into external business opportunities. And so I do think there is some kind of bad blood that was left here. Unfortunate, but this is how things typically roll at Aave.
Go ahead.
No, I mean, it's just, it's in a system like this. I mean, keeping third-party representatives on is difficult, especially with the demands that Aave has for its third-party actors. So, yeah.
What does it actually mean, by the way, a third-party actor? Like, can you maybe explain this relationship between Aave and Gauntlet? Maybe share some info on it?
Well, I mean, like Gauntlet provides risk management services. So they go in and essentially like look at all the loans and then provide recommendations on how the LTV should be updated, how much should be lent out against each asset, and essentially look at the entire market of debt and try to understand what's the best way to allow for lending and borrowing without taking on too much risk, which is a very difficult process. We did post this on Leviathan yesterday on the news feed, that it was a cheeky reply from WXY, where it talked about Gauntlet's bill for services rendered. And you can see that, you know, there's some treasury management, risk management, distributing our rewards, and then $10 million for dealing with Mark Zeller.
People love to do some funny stuff, man. People love the funny stuff, at least that.
I know.
Where is that from? That screenshot from the forum?
No, it's from Twitter user W_YW_X.
Yeah, but it looks like it's like a photo from a forum or something like that, no?
I think he just made it. Yeah.
Do you guys know, like, I don't know, maybe you're sort of more familiar with the drama than me. Do you know, like, the origin story here? Like, what, like, where this all came from?
So I believe the rift really started to take place once Gauntlet essentially came and provided analysis from their part that they should offboard CRV on Aave v2 completely and take not just offboard it in the long term to Aave v3, but to take very aggressive steps to reduce the risk to the Aave v2 pools at the time.
Yeah, the CRV is the big story, you think?
Yes. So CRV was generating buku amounts of revenue for Aave, and Gauntlet essentially wanted to come in and shut that revenue stream off. And I think that the rest of the Aave DAO felt that the risks were okay. And in hindsight, they were, because CRV did not collapse and that massive CRV position was not liquidated on Aave at the time. And so I think that's where the rift kind of culminated, and it took another 4 or 5 months for it to essentially come to the point where Gauntlet felt that they did not need to provide services anymore.
How much is Aave earning from that CRV, from the position by Mitch and the whole thing? Like, how much money was on the table when actually Gauntlet told them to like cut the CRV market off?
So I believe that position was quite large, actually. Let me see if I can find it.
Yeah, Aave would not have passed on this kind of money easily.
My feeling on this is like, I guess, I think it's important to understand the incentive structure of like a risk provider like Gauntlet. And now I'm not intimately familiar with the details here, but like it seems to me that like, you know, like a risk manager, they have no upside incentive, right? So it's like their incentive is like, don't let anything bad happen. But like ultimately, like running a lending protocol, it's a balance of risk and reward. If you don't take any risk, you'll never make any money, right? So it's like, you know, it's not like minimizing risk is the only relevant factor, right? But like for someone who has their reputation staked on like not having bad things happen, that is their only incentive, right? And they're not incentivized to like take risk at all. They're only incentivized to reduce risk. And so I think it's like something maybe that, Mark Zeller kind of had a bone to pick. Is that maybe it feels like, you know, like their word should not be taken as gospel, right? Because it's like you just have to recognize their incentive, and like, the incentive of Aave token holders and the Aave DAO is not fully aligned. And I think you just need to recognize that and like not just do everything that they say.
Yeah. So the CRV position was eventually offboarded at the end of November. The pool was frozen, and it was no longer allowed to essentially borrow. And after that point, Mitch moved pretty much his entire position over to Silo, and Silo has taken in the majority of all of that CRV. But I did think that it raised significant issues within the community at the time, and this is essentially the outcome of that. The other thing that I wanted to talk about today was a proposal that came into the Frax forums yesterday.
And this something.
Yeah. So this was a proposal to merge FPIS into FXS. So this is something that's been discussed at length in the Frax community for the past several months. It is an ongoing issue that people have wanted to see, resolved. And so 2 years ago in 2022, Frax launched FPI, which is the Frax Price Index. That is an inflation tracking stablecoin that essentially moves up or down depending on how much inflation or deflation there is to the US dollar. Typically, there is a little bit of inflation. Over the long period, it's about 2%, but sometimes, like we saw in high inflationary periods, that move can go up to, say, like 10% a year. And so the idea is that you put your dollars into FPI and it's inflation protected. At the time, Frax airdropped a second governance token called FPIS to the FXS community, depending on how much VEFXS they had locked at the time. And I think there was a lot of excitement for how it could work and anticipation to see how FPIS could grow as almost like a sub-DAO within Frax. However, I think as we've seen that if you have a single protocol function and a single source of revenue, the token that sits on top is almost has this like hyperconvexity, where during the good times the token will trade really well. Maybe it spikes up in price because people are seeing all the high revenues. But if there was a systemic event, say inflation went above the US Treasury rate again for a significant amount of time, well, the governance token that sits on top, again, would have this with almost hyperconvexity, where it would immediately be sold to the downside, the market cap would get sold off, and there would be a threat to the peg stability of the underlying asset that it's trying to hold. And I think that this was kind of readily found out with FPI and FPIS after its launch. And so the cap on top of FPI has not been raised more than 100 million since it was launched due to these risks. I think that $100 million is a pretty like reasonable figure. You know, it doesn't require, I mean, you're probably putting at risk maybe like $2, $3, $4, $5 million of capital to hold those funds. But if that was to be expanded up to like $1 billion, now you have quite a lot of funds that could be at risk. And especially as we saw with inflation beating out US Treasury rates in the early part of 2022 by almost like 5%. That's a lot of capital when speaking about FPI and the risk that it would provide for FPIS. Because
how much again? Can you say?
Well, let's say that like FPI scaled to $1 billion, right?
Okay.
And then inflation goes to 10% again, and U.S. Treasury rates are in the 4s and 5s. Well, now there's a 6% gap that has to be covered somehow, and you're talking, you know, what, $50 to $60 million a year of capital that would need to be recouped somehow to keep the FPI peg. And so I don't think that you can do that with just a single revenue source in the FPIS token. I think that's what the Frax team found out as well too. So the idea now is to essentially merge FPI back into Frax, back into the FXS token, because FXS has a lot of revenue sources from lending, from stake Frax ETH, from soon to be Fractal as well too. And so in theory, during times of high inflation, any type of like fees that need to be paid out to FPI to keep the peg should be manageable because of all the different revenue sources. And so there has been an ongoing discussion within the community about merging FPIS back in. Yesterday, we saw a proposal to do that. And I think that we'll just look at the summary here. It says merge FPIS tokens back into the FXS distribution at a fixed exchange rate of 1 FPIS to a 4-year VEFXS lock, meaning that in 1 year, 1 FPIS can be withdrawn from VEFXS as 1 FXS if a user does not extend the lock. And so the issue here that I think people have been in great discussion inside the Frax Telegram chat is that as of publishing this proposal, the price of FPIS is $1 and the price of FXS is like $8.50. And so if this were to pass as written, there's a massive arbitrage opportunity to essentially come in, purchase as much FPIS as possible, and then lock it as VEFX in this swap. And then essentially you would just have to hold for a 4-year period, and there would be a almost guaranteed 800, like somewhere between 400 to 800% return on your funds.
Of course, just according to current prices, like no one knows.
Of course. I mean, and you think that Frax 4 years into the future, I mean, that Frax shares token might be trading at 100. I mean, we don't know what it's going to be, but if that's the case, then you would essentially 100x your funds on this arbitrage opportunity.
How's the community responding to it, by the way? I saw some comments on the forum yesterday, and I think I'm mostly curious about like, doesn't it dilute FXS too much, or puts at least like the risk of diluting FXS a bit?
Yeah, so it would be a major dilution event. I think that if we scroll down here a little bit, we can see a response from Hologram, who talked about saying that there's currently 40 million FXS, or $345 million of value currently locked, which accounts for $88 million worth of VEFXS. FPIS currently has a circulating supply of 26 million. So if it were to be converted 1-to-1 with a 4-year lock, that would add essentially 160. 160 is too much. It's around 100 million new VEFXS. So the dilution would be about 50% for VEFXS holders, and so it's pretty significant, right? Like if let's say that I hold equal amounts of FPIS and Frax shares, or like I have some locked VEFXS today. Let's say it's worth $100,000, and that would be around 12,000 FXS. On the other hand, I could buy $100,000 worth of FPIS, which yesterday was trading at about $1.20, and that would give me around 80,000 FPIS. And so, if I was to actually lock and convert it at that rate, at the end of the 4 years, I would end up with 80,000 FXS. Well, the person who started with $100,000 worth of just plain FXS still has their 12,000. And so I don't know. It doesn't really sit right. Sam came out and said later that it's just an initial proposal. Everything is pretty much up for discussion about like what the ratio should be, but it does need to, like, having thought about it at length. I do think that the equity swap, essentially, of taking in FPIS and then swapping it into VEFXS is the right thing to do. The question really is like what that ratio needs to be. Should it be at the market price of what FPIS was trading at yesterday before the announcement, which was like about $1? Should it have a bit more premium because you're locking it up for 4 years? These are all questions that are going to have to be discussed at length in the community over the next week or two before the proposal goes to vote.
What's the total supply? Like the total supply of FXS is 100 million, right?
Currently, I think it's about 70 million.
Yeah, but the maximum supply, I mean, it's about 100 million, right? With FXS.
Yeah, it is 100 million.
And how much is currently locked as VE?
About 40 million Frax.
About 40 million for Frax. And what about FPIS? Like, what are the stats there? Like, also, is it 100 million like max supply and like the same amount out, and how much is also like VE locked?
Yeah, so the FPIS supply is also 100 million, but about 60% is held in the Frax and/or FPI treasury, which means that it's not going to enter the circulation.
Yeah, and I saw that they are proposing to burn most of it, right? All of it, most of it.
Yeah, that would be what would take place. So if we take a look at the distribution of how the tokens are, there's 30% of the tokens. This 55% made of the treasury tokens would just be burned. There's been we just hit the halvening for the second year, so there's about 7.5 million tokens which have been minted, or 7.2 million tokens which have been emitted. The airdrop was about 10 million tokens, and then there's another 8 million tokens which have been distributed through a vesting period to core developers and contributors. And that brings the circulating supply to where it is today of 26.76 million. And that continues to grow as time goes on and emissions continue to expand.
And is like the FPIS, can you maybe share a bit about like how was its value accrual model? Because I remember that back then they really did want to like split both governance and revenue, if I remember correctly, of whatever they were trying to build with the whole FPI idea.
Yeah, so we can take a look at the revenue sheet here for FPI, and essentially Frax has to provide a rate. So the annual inflation rate right now is 3%, and as long as Frax is able to earn more than that, then there's revenue. Right now, yields are pretty high, so the short-term treasury rate is about 5%. So Frax can have a spread of about 2%, maybe a little bit less, depending on fees that it can earn. And so looking at the revenue charts, it's been pretty positive. There's only been about 3 months during its entire life cycle where FPI has not made money. Obviously, this can change. It can go up and down, but it has been a good source of revenue through its lifetime. I believe it made just about $1 million last year on $100 million worth of TVL.
And do you know percentage-wise, like how much does that in relation to what FXS is accruing so far?
Well, I mean, it's a separate product, right? I mean, I believe, I'd have to look at. Actually, I can bring that up. Give me 1 second. I can tell you exactly how much Frax has been making. We just did Frax Check a couple of days ago, and there was some profitability there. If you come to Flywheel DeFi, we publish Frax Check every 2 weeks, covering the profitability. And so, for the month of February, the Fraxland AMO pulled in $200,000. There was also some liquidations as well too. FPI brought in $67,000, and then Frax ETH brought in about $175,000. So close to about $500,000, maybe a little bit more in profit. I don't think some of the other revenue sources are brought in here, but I think it's close to $1 million for that month, maybe a bit more. But the FPI needs to come into the system because it's the only way that FPI can grow. It needs to be backed by a token that isn't just got its revenue sources from that inflation spread. And so, yeah, this is going to be an ongoing discussion in the Frax community for the next few weeks.
I think that for VFXS holders, it's not going to be that simple to like accept it. Because I think that for holders, like this kind of a dilution, even if it's mostly on paper, it's pretty scary.
Well, I don't see it as that. I just see it as like there needs to be a merge, right? The merge has to happen. I think the question really is like, how do you navigate incentives between three parties, right? So you have parties which hold FXS and have no FPIS exposure. You have parties which might hold both, that have both FXS and FPIS, and then you have people that just hold FPIS. So the people who just hold FXS, any sort of high valuation for FPIS is going to represent like a dilution event for them because they don't have any exposure to FPIS. The largest holders of both FXS and FPIS have both exposure to both assets. So they have incentives to, they have incentives on both sides. So they almost cancel out, right? They have incentives to provide as high of a valuation for FPIS.
It's like they're diluting themselves, you say.
Yeah, they're just diluting themselves. So there's like net, it comes out to, it might even be beneficial for them, right? Because regular VFX holders just get diluted down and they get more of a market share. And then people who just hold FPIS, I mean, it's great for them because they get swept back into the Frax ecosystem at an extremely, extremely high valuation.
Does this mean that the max supply will change for FXS?
Potentially. I mean, it depends on how much Frax shares there is in the treasury at the end of the 4 years, right? So if Frax is like buying back FXS and has all that 26 million FXS in the treasury at that time period, then no, there would be no supply increase. If it doesn't, then there would be. And that's only if people unlock and take it out as well too.
Teddy, you look like you want to ask something.
Yeah, I mean, I was just going to ask why isn't it like why wouldn't the default be to just buy FPIS at the at like the current market valuation? Like I guess that's why I don't understand. Like why isn't that the default?
Well, I think it's politics. I think that Sam had some comments inside the Frax chat yesterday, essentially saying that Convex had provided significant incentives for the CVX FPIS pair, and that they wanted to command a high valuation to recoup some of those costs. So looking at, I'm just going to bring up my Telegram here. We can take a look at some stuff that Sam said. So Sam said, I think that one thing that people don't consider is that there aren't just completely separate things. Convex has spent a lot of incentives to integrate CVX FPIS. The core team has to answer and devote attention to it. It's easier to say FPI shot, it's shot, but you're not the one that has to answer about it or continue to support it. We are. And as you can see by the chat history here, it's been months of discussing possible merge ideas and people asking about it. So like with anything with DAOs, I mean, your biggest voters kind of drive the agenda, right?
So is he suggesting he's trying to shield Convex, like he's trying to like bail out Convex to some extent? Is that kind of what he's saying? I don't know if I'm reading that right. But like they spent a lot of money to do this perhaps at the behest of Frax, and now they're angry if like you just wipe FPIS off the board. Why did they spend all this money? And Convex is angry about that?
I mean, that might be the case. I mean, we don't see what a lot of the political discussions are. They haven't come out in the open yet, and I don't think that C2 has made a comment yet. Let me just check the chat to see if he made something overnight.
Because I do remember, like for example, the way that I learned about back then about FPIS, it was that if you locked, if you held the CVX FXS or locked, if you took your FXS and converted them to CVX FXS, you'd also be eligible back then to the FPIS airdrop. That's how I got a few tokens myself.
Yeah. So C2 made a couple of comments in the chat. I've seen 3 since this morning. Somebody was talking about like creation of perverse incentives here. C2 comes in and says it's been talked about merging for months. No real thoughts or discussions made by the community. Proposal drafted and displayed. Everyone coming out of the woodwork to voice opinions. Sounds like it's getting feedback and participation. And then further, he said that there's going to be some small talk about the ratio or whatever, sure. And he said, point is, you got to put it out there before people start caring.
Fair.
Which he's right. The discussion doesn't really start until there's something to actually discuss.
Yeah.
And now there is.
Gonna be interesting. Honestly, gonna be interesting. Frax is doing so many things and is like evolving so rapidly and so immensely that I do think that in the long run, it's a very important decisions that Frax is taking there. And I will say that I think that I don't think that the FPIS has been like that. I mean, the token itself and the revenue that has generated. I can't say that I was blown away these past 2 years, but you know what I mean. And I do think that getting it back to one token that really like I know that you guys like to say that the FXS is king. I think it's healthy for the ecosystem in the long run.
Yeah. I don't think the sub-DAO model works. Like you can't have multiple tokens within one thing. It just makes sense to only have one.
It's difficult. Yeah, I'm very curious about what's going to happen with Berachain, by the way, because I know that they have also a model with at least 2 tokens and another stablecoin, right?
Yeah, but their model, the second token, so like there's like one gas token, but then the actual like voting token is non-transferable. So it's not like
okay.
So it works a little bit differently. It's not a second transferable token.
So it's a one token model, you say, in a way.
Well, there's a gas token and then there's
Yeah.
a governance token, and the governance token has no transferability. So it's
Cool.
not like there is a second token in the first place. There's just like points that you accrue that you can use to vote, but you can't use those points to collateralize anything.
Cool.
Yeah. Look, I think, I hold both FXS and FPIS, and so like I was thinking about this in from a rational perspective on being on both sides, and like, as an FPIS holder, like I want to get the best return on my tokens that I bought and have been holding. But at the same time, as a FXS holder, like I don't want to have any sort of dilution. And I would assume that as the Frax is the larger protocol here, I mean the market cap, the circulating market cap of FPIS coming into yesterday before the proposal was announced was around 33 million, versus Frax's like 600 or 800 million or somewhere around there. So it's 10x the size. I wouldn't assume that Frax would give a bad deal. Like it would be the one that's in the position of power to essentially dictate the terms of what FPIS is given, and that FPIS, as the smaller community and smaller protocol, is essentially forced to accept it, because if Frax essentially pulls its support in some way, I don't know how that would happen since they're so close to each other. Without Frax, the FPIS token essentially goes to zero, and so the FXS holders are in the driver's seat here. They do have all the power when it comes to dictating the terms, and I just assume that the market rate would be whatever we would get, or maybe a premium to market even. Since if there's a 4-year lock, so if somebody's asking me to lock up for 4 years, I mean, how much of a discount should there be? Maybe like 30, 50% or something, but nothing too extreme as this, where it's like 800% over.
Yeah, it really seems like, I mean, and granted, I'm not super familiar with the situation, but it really does seem like it's like just rife with conflicts of interest. Like it would be so much simpler if like they were actually separate, because like, yes, they're separate tokens, but it's the same people, right? Like, and so it just seems like it would be much simpler if they were actually, like, if the separate token meant that there were like separate people that were doing the thing, and then you could have a real conversation. But it seems like super sticky.
Yeah, I'd guess that it's like 80% the same people, no?
Probably. And that's what makes it sticky, right? Is that like who are you going to bat for, right? And I think at the end of the day, that even if you hold both, you still have to go and take the position of the majority of the FXS holder first, because that is what your majority token stake is, and this minority token can't be used to essentially backdoor way in to get massive voting power here.
Do you think that it's going to be that the ratio there is going to remain 1-to-1, or that it's going to drop?
I would highly doubt that it stays 1-to-1. I would probably expect something closer. But I mean, like, personally, this is just my personal opinion. I think at the best case, it should be something like 4-to-1, which would be about $2 per FPIS.
Yeah, and
that is essentially like, and that's asking for a 4-year lockup as well too. So it's a 100% premium on what the price was trading at before the proposal was made. People are asked to lock for 4 years, and they can convert into FXS after that. I think that's reasonable. That's a really good deal for FPIS holders who didn't really have an exit, because if everybody ran for the exits on liquidity, I mean, the token would essentially go to zero. So having a 2x buyout in this case, I think is a great bone that's being thrown.
And-
But anything more than that, I think would be excessive. But that's just my personal opinion.
Yeah, I tend to agree. What was the market cap of FPIS before the proposal?
33 million circulating.
13 or 30?
33 million circulating.
33.
Yeah.
And Frax is like at I don't know, like over $500 million, right?
Yeah, over $500 million.
FXS,
Well over
I mean.
$500 million. Yeah. So it just the if it was proposed, if it went through at a 1-to-1 valuation, it would be valuing FPIS at around like $230 million.
What, like fully diluted? Or
circulating.
not even fully diluted.
Circulating, yeah.
Wow,
Yeah.
fully diluted, it's gonna be a lot.
Like 800 million, right?
Yeah, wow.
Because there's 100 billion tokens. Yeah. Yeah, and look, I wouldn't like. I mean, Rex says that it's like isn't growing or dying. I mean, like the growth or it dying is just not. It's self-imposed. I think there was discussions around raising the cap for FPIS, but it just wasn't done for safety reasons. So it's not that. I mean, they could raise the cap tomorrow. I mean, they could expand the FPI supply cap to $1 billion tomorrow, but it doesn't mean that it would be the prudent or right thing to do.
Yeah, it feels like, I mean, just like as an outsider, it seems like what's going to end up happening here is basically what you said, Sam, where it's like there's a premium. It's like not crazy, but there is going to be a premium, and it won't be enough where like FXS people will be too pissed, but it'll be enough that like FPIS people feel happy. It seems like that's just what's going to happen. Like, yeah.
Yeah, I think the main thing at the end of the day is just to understand like how it affects the voting structure, just how much new VFX is being added, and what that means for voting in the DAO like post merge, because like we said, the addition of essentially doubling the voting power overnight may have some implications across the entire protocol for how things work. And I just think that is too significant of a change to take in right now. Again, I'm just a small fry, but I do think that people's voices are being heard, and the Telegram chat has been extremely active over the past day. But if it does go through to 1-to-1, I mean, buy as much FPI as possible and go and stake it, because it'll be the trade of the century probably.
Honestly, gonna be interesting to follow this one. It's one of the more interesting governance stuff that I think I've seen in the last week or two.
Yeah, we're gonna keep up on it. I think that we're gonna have a discussion in the afternoon with Flywheel on Spaces, so we'll have more voices there. You'll be here. Like I think that I can be hyperbolic at times when it comes to politics. And probably a bit unhinged, but that's why we have a podcast here, is for like unhinged hot takes.
Yeah. What will I say then? If you say that, what will I say?
So make sure to tune into that.
When is the space? Actually, it's interesting.
So the space will be today at 5 p.m. Eastern, and then tomorrow we're actually interviewing Garrett for Flywheel. So yeah,
cool.
That'll come out in a couple of days. Cool. But anyways, thank you for coming today, Teddy.
Yeah, thanks for having you guys. It was great.
Yeah. I'm glad to hear about Notional, and really excited to see the growth of what you guys are doing.
Thank you.
Definitely, and good luck there with going to Mainnet and stuff. Going back to Mainnet.
Man. Yeah, I'm excited. I think it's gonna be great.
All right, thanks.